Joining us now is the Cameron Dawson, Chief Investment Officer, New Edge Wealth. Cameron, thank you so much for joining us. All right, it's September to remember. We'll see, right? We've heard from voice after voice with the talking point that September is historically weak. It obviously started out weak. Got potential catalyst in front of us today from the tech sector. You also note the weakness in September. You say, wake me up when it's over. What do you expect?
Yeah, singing a little Green Day, wake me up when September ends, because we do know on average that September is the weakest month of the year. But it's one of those things that if everybody's expecting it, maybe does it not happen. But we do think that if we see a little bit of chop and churn in September, it doesn't necessarily change the course of this rally. We think that because so many institutional investors sat on the sidelines through the big rally coming off of those April lows, and we're only just now getting to a position where we see institutional investors being overweight, we think that that creates a setup for a big positioning chase potentially into year end, meaning that you have people chasing the names that have done the best through window dressing and making sure that they get fully invested because returns have been much better than many people were expecting. So maybe some chop and churn in the very near term, but of course a setup for a potential Santa Claus rally as we get into the fourth quarter.
Where do you see that chase heading? I mean, I've heard a lot of talk recently about flows going to small caps and looking for some kind of return there. What's your thought on that, Cameron?
Yeah, definitely. When we think about what has characterized this market a lot since the April lows is that it's all been about pain trades. Where people are the least positioned tends to be the area where you see some of the best performance. And so one of the things that we've been noting is that you're seeing extreme outflows from small cap ETFs. So if you look at the largest small cap ETFs, the rolling 3-month flows have been deeply negative for the past few months, despite the fact that small caps have been sneakily outperforming. So we do think the pain trade in small caps is higher. Now, we don't think it lasts for a very long time. It's a classic, we're here for a good time, not for a long time, because we don't see great fundamentals within the small caps. You still are seeing earnings revisions move lower. Valuations aren't really that attractive when accounting for the fact that earnings aren't that strong and that they're likely to be revised even lower. So this is more of a positioning chase, not necessarily some big turn in small cap fundamentals.
Good time, not a long time. Okay, where else do you see rotation potentially taking place as investors trying to find opportunities?
We do think in the short term, we could see a little bit of a rotation into value out of growth, simply because growth went so parabolic over the course of the last couple of months. And we saw that story play out in 2024, in the second quarter, as well as the fourth quarter of 2024, where you saw massive growth outperformance, which was then followed by a little bit more digestion. So we wouldn't be surprised if value had a little bit of its time in the sun. But again, this value fundamentals aren't that great compared to growth fundamentals. You're still seeing earnings revisions lower while growth earnings revisions are moving higher. So again, it comes back to just a digestion of big outperformance, a digestion of more crowded positioning. And so for a very short period of time, you could see value have its time, but likely we're still in an uptrend for that very important growth versus value ratio.
Okay, I want to ask you your thoughts on this. We've been obviously paying a lot of attention to fixed income. Yesterday, you saw yields pop. The 30-year had briefly topped 5%. Little movement on the 10-year today. What do you make of where we stand, and what does that signal to you?
Yeah, it is very important because the 30-year has been the capture or catch-all for all these fears about things like fiscal dominance, sticky inflation, debt and deficit worries, demand for duration around the globe. And I think it's very important to know that this isn't just a US phenomenon. It's German bunds, it's UK gilts, it's Japanese JGBs. This is all around the world where we are seeing less demand for duration and concerns about the debt and deficit and fiscal dominance. So the big question is, at what point do these higher yields either restrict government's ability to be able to spend, that classic bond vigilante, and then at what point point does it impact corporate profits? Because as we think about it in the context of the US, yes, a 30-year yield pushing towards 5% is jarring, mostly when we think about valuations being so high on equities. You think about your equity risk premium. But at what point does this start to restrict governments to be able to spend? Because government spending has been a huge contribution to GDP over the last few years. So it's certainly something to watch, and certainly something that could give pause to valuations that are trading at multi-decade highs.
Cameron, I want to ask your thoughts on this. Obviously, we are looking towards the jobs report on coming Friday. A lot of attention is going to be paid to that, especially given the last monthly payrolls report, which showed weakness, and then you had the revisions of a few months, which showed more weakness than expected. What's your expectation heading into this August payrolls report that comes out Friday?
It's a classic choose your own adventure, mostly for the interpretation for the Fed. So consensus is at about 73,000, which is effectively flat to what we got in the July print. And we think that if you got a beat to the upside of that, then it would make the September odds for a rate cut potentially fall. Even though we heard from Powell at Jackson Hole that really setting up for a September rate cut, it's good to remember the Fed goes into its blackout period on Friday as well, prior to their September meeting. So we could be in this sort of no man's land of uncertainty if we get a beat to the upside. Now, if we get a miss to the downside where we come in even below that 75,000, that's when you're likely to see the odds of a 50 basis point cut go up. We don't think that that's likely that the Fed would deliver that. Very different than what happened last year when they delivered a 50 basis point cut. But certainly it could be a source of volatility, mostly a source of volatility at the front end of the yield curve, where right now you have quite a few rate cuts that are being priced in. So either that will be reaffirmed or potentially contradicted by this Friday jobs payroll report.
Cameron, I want to go back to the point you made earlier about the chop that we could potentially see this month and potential for a surprise, especially leading into more flows through the end of the year, especially the holidays, Santa Claus rally. If there's this chase into the end of the year and you could potentially see 7,000 on the S&P 500, well, could you see 7,000 on the S&P 500 through the year end?
Yeah, I think that is such an interesting way to look at this, which is that if we get the kind of chase into the year end, then let's say we get to that 7,000 level, where does that set us up for in 2026? Because if we take current consensus for 2026 earnings, which is about $300 a share, that would mean that we were trading at 23.3 times forward earnings at 7,000 on the S&P 500. That 23.3 times would be above the 2020 high in valuations that we got to during the COVID era. It's important to remember, in COVID, earnings were depressed. And so over the course of the next 18 months, once we hit that 23 times forward earnings grew 75%. We don't think that this is a market that's going to be able to grow earnings 75% over the next 18 months. So the big question is, will valuation start to matter? The challenge you have is that you could have made the same exact argument at the beginning of 2025 and said, this is a reason why returns should be lower. And the end result has been, we've actually had a pretty stellar year. So valuation's not a good timing tool. Eventually it will matter. We're watching things like liquidity, growth expectations, risk sentiment, all things that play into that valuation game. But if we get to 7,000 by the end of the year, that's going to be a pretty big high bar for 2026.
All right, certainly could be the setup for a high bar. That's Cameron Dawson, Chief Investment Officer, New Edge Wealth. Thank you, Cameron.